So then, macro forecasting is not critical to investing. We do not make our decisions based on macro forecasts, as I explained to you. We all have opinions. Our official dictum is that it's okay to have an opinion. You just shouldn't act as if it's right. And I think this is very important. You know, Mark Twain said, it's not what you don't know that gets you into trouble. It's what you know for certain that just ain't true. And so we try to avoid holding strongly to those macro opinions. And finally, we don't do a lot of market timing, which is very, very hard to do. We do long-term investing in assets that we think are underpriced. So that's the Oaktree philosophy. You can see how the origins and inspirations that I went through fed into that. And in fact, it's all distilled in our motto, which says that if we avoid the losers, the winners take care of themselves. And if we can make a large number of investors and just weed out the problems, then we'll have, just think of the bell-shaped curve. We'll have a lot that do okay, and an occasional one which is exceptional, if we can weed these out. So a lot of money managers go into the clients and say, we will get you in the top quartile, into the great right-hand tail. I think it's hard to do on a consistent basis. And if you aim for the right-hand tail and you miss, you end up in the left-hand tail. What we say is, we'll just lop off the left-hand tail. And if we can do that successfully, and we pretty much have, then what'll you have? Okay, good, very good, great, terrific, but no terrible. The average will be very good. And that's basically what we've had. So lastly, I'll just leave you with what I consider my three greatest adages, not mine, but the ones I've encountered over my career and that have been the most helpful. And they're all used in the book. First of all, what the wise man does in the beginning, the fool does in the end. In every trend in investing, it eventually becomes overdone. If you find an asset which is cheap and buy it, that's great. If everybody else figures it out that it's cheap, then it'll go up. Then people see that it's rising, and more people jump on the bandwagon, goes up, 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 and the last person to buy it is a fool, and the first person to buy it is a wise man. It's the same asset, just at different prices. And as people say, first the innovator, then the imitator, then the idiot. So that's another way to look at this adage. Number two, never forget the 6-foot-tall man who drowned crossing the stream that was 5 feet deep on average, kind of like that skydiver who's right 98% of the time. It's not sufficient, depending on how you want to live your life, to survive on average. We have to survive on the bad days. So we have to be able to survive the low spots in the stream. Your portfolio has to be set up to survive on the bad days, so you won't be shaken out of your investments. And then finally, being too far ahead of your time is indistinguishable from being wrong. And yet that's a great challenge because, as I said before, the things that are supposed to happen will not necessarily happen, and they absolutely will not happen on time. So you have to be able to live until the wisdom of your decisions is proved, if at all. So all of these things, I think, say something about modesty and humility of belief rather than cocksureness, which I think is the greatest risk. So with that, Saurabh, I'll stop talking, and we have a little time left, and I'd love to take your questions. That's what I'm here for.
Thank you, Howard. This was fascinating. So we are open for questions. Please raise your hand, and I'll bring the mic to you.
The thing you said about what the wise man does in the beginning, the fool does in the end, you can come up from a single stock, and you can think about your whole philosophy that way. So you've been focusing here on avoiding losers. And maybe humans are kind of generally focused on trying to find winners. Maybe that's what we'll always do wrong. But if everybody in the world is trying to avoid losers, maybe the wise investor now shoots for the winners. Do you know what I mean? Sort of self-balancing.
Sure. Well, number one, I don't think that we have to worry about everybody becoming too prudent or too wise, because we're talking about human nature. Charlie Munger, the boys went to see Charlie Munger this week. One of the great quotes that Charlie gave me was from the philosopher Demosthenes, who said, "For that which a man wishes, that he will believe." What do most people want more than anything else? They want to get rich. Very few people think that the future, the secret to their happiness comes from prudence and caution. Most people think it comes from that stroke of genius which will put him on easy street. But you're absolutely right. And there are times when most people behave in a prudent and cautious manner. When is it? It's in a crash, when security prices are down here, right? That's the time to turn aggressive and buy. So Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. And there are times when we should turn aggressive, and that's when everything's being given away.
So you said that you do not predict, you did not make any macro forecasts, right? But actually, the macros can affect companies in a lot of ways. Like, I mean, if you have interest rate like 30%, I mean, 99% of the companies will be gone, or something like that, right? So how do you even make an investment? Okay,
so now I know I'm not coming back to Google anymore because the people are too intelligent. Because this is one of the great traps. I say that we don't invest on the basis of macro forecasts. But you have to have an economic framework in mind when you predict the fortunes of individual companies. What I would say is, what we try to do is it's one thing to say that oil is at 50 and we're going to invest in this company because it will do fine if oil's at 50, survive if it goes to 30, and thrive if it goes to 70. But it's another thing to say oil is 50, I think it's going to 110, I'm going to invest in this company, which is going to be great if it goes to 110, but bankrupt if it stays at 50. So the question is, how radical are your forecasts? And we try to anticipate a future that looks pretty much like the norm, and make allowance for the thing that things other than the norm can happen. And I can't really be much more concrete than that. It's all, all this, by the way, all this stuff is judgment. There are no rules, there are no algorithms, there are no formulas that always work. None of this is any good unless the person making the decision has superior judgment. And the first chapter of the book says the most important thing is second-level thinking. Most people think on the first level. To be a superior investor, you must think on the second level. You have to think different from everybody else, but in being different, you have to be better. So the first level thinker is naive. He says, this is a great company, let's buy the stock. The second level thinker says, it's a great company, but it's not as great as everybody thinks it is, we better sell the stock. That's the difference between being an average person and a person with superior insight. By the way, most people are not above average. Yes, sir.
Do you think diversified index funds adequately protect the amateur investor from losers?
Well, this is a great question. The role of the index fund. A lot of people say, I'm going to take a low-risk approach, I'm going to invest in an index fund. And they are confused. What an index fund does is it guarantees you performance in line with the index. So the point is, because of the operation of what's called the efficient market, not many people can beat the market. It's true. Most mutual funds do not beat the market. Most mutual fund investors would be better off just being in an index fund. And in fact, most active investment schemes impose fees that they don't earn. And that is one of the major reasons that most active investment schemes perform below average. So the index fund, which is called passive investing, yes, it does reduce, it eliminates the likelihood that you fail to keep up with the index. It also, of course, eliminates the possibility that you outperform the index. So you trade away the two sides of the probability distribution for surety that you get index results. So, but it doesn't eliminate the risk of the investment. It eliminates the risk of deviating from the index. What you have to keep in mind is that the index fund investor loses money every time the index goes down. Why? Because there's no value added to keep it above. So, by the way, index investing is a fine thing for the average amateur investor, because the average amateur investor, number one, can't beat the market. Number two, can't find anybody or hire anybody who can beat the market. But the only thing is, he shouldn't think that it's a riskless trade. It's, you eliminate what we call benchmark risk, but you retain the risk of the underlying assets.